drug pharmacy dude, Martin.
And one of the ways you can think about this,
Shkreli.
I mean, this is basic finance, but this might help you. One of the ways you can think about this, and I hope somebody clips this because I'll teach you some basics here. AstraZeneca is going to make 918, 1014, 1115, or 1150, 1268, 1406, and let me get the 2030 number. 1526. Okay. Let's assume this is true. This is like the finance I taught dudes in jail. Let's assume this is true. Okay. These are the years you're running a business. Doesn't matter what you're making, pills, software, widgets, doesn't matter. But this is the earnings that we're going to see. This is pretty good. 10%, 14, 10, 11, 9. So after what, 5-6 years, you're getting 66% growth in earnings from 2025. So that's a pretty robust growing business. Okay. We know that the street likes to pay 20 times the earnings. Why do they pay that? Well, that's a different lesson. But they like to pay 20 times earnings. Okay. So what's the stock price now? Well, let's check. $90.61. Now, an ADR of AstraZeneca is worth two per share, for what it's worth, and they have a little net debt, but they pay 20 times earnings for the local share, and the ADR is 2x. You get half a share, so you have to cut it in half. Anyway, so basically, for the ADR, it's all 20 times earnings. So right now it's $90, but if the earnings are going to grow like this, why won't people pay 152.60 right now? For these earnings, 20 times earnings. Well, in 2030, they're going to pay, if this comes true, which we're going to assume, they're paying 153. They're going to pay 153 in 2030. How does that help you now? What does that mean? How do you think about that? Right? Imagine you close your eyes, you rip and Van Winkle, you wake up, and in 2030, the earnings per share is $15. You went to sleep when it was $9. Now the earnings per share is $20.30, and it's $15. And the stock is trading for 153. That listing doesn't matter. There's a few ways to look at this. Well, you say if I hold from then to now, I will generate an 11% return. That's one way to look at it. And you say, is that good? Is that bad? Well, what's the risk-free return? Well, that's just the 10-year yield, right? What's the 10-year yield? Anybody know off the top of your head? It's like 4.1%. Let's just assume it's 20 times earnings. That's what the market's paying now. They may pay less in the future. They pay more in the future. Not our concern. So this is the risk-free rate. This is our return. How about the AAA bonds? What are those yielding? Anybody know? AAA is 5.3. There you go. Meme knows. How do you know, Meme? How about BBB or B? You need to also adjust for...
That drug pharmacy dude, Martin. What's his
You
name?
make sure it's the right duration. So that's 6%. And how about some junk? I mean, is that junk? I think that's junk, right? Sounds like junk is more like 7. Okay. And what have equities kind of returned over the last 10 years? Should we do that one? Maybe let's do a couple of them. How about that? So let's see, 5-year return on equities. Let's take today's price. And then, I don't know, let's take, that's 1 year, 2, 3, 4, 5, 3760, 2 minus 1. So this was an 82% return over 5 years. But we have to do rate. 5 years minus this, that. So that's 13%. So if we keep going as we've gone for the last 5 years, that's actually not a great return, the 11% return. We could do better if we just bought a generic stock, but is that the best way to look at it? Well, let's see. 2134, if we do the same math, that's over 10 years. The return's going to drop a little bit to 12%. It's been a really good decade for stocks, my man. Let's go to 15 years. Yeah, market's very overvalued. Still 12%. And let's go to 20 years. Let's get to, this is what starts to make it a little ugly. %. Now, that 11% doesn't look so bad. And it's a pharma company, so it's probably a little safer than your average stock, right? But let's keep going. Why not? This is fun, right? $2,000 was 1552.87. Uh-oh. That sounds not so good. 25-year return on stocks. How are we treating dividends here? Does it matter? It does matter, of course. 6%. $6.1%. So versus 6.1%, that sounds great. And we're not done with this lesson. It's going to be very interesting, but let's do a couple more years. Interesting here, if you go back to 1995, market's gone up 10x since then, but it also has been 30 years. That's 8.3%. So I'm going to do 20, 30, and this is 5, 10, 15. And then let's do, should we do one more? This is 35 years. The market's almost gone up 20 some odd percent. And again, this doesn't mean that the future market's going to do this, right? Why is the US so special? Well, you know, we've had a great run, but is it going to be like this forever? Well, it depends on how many Lena Khans and AOCs we get. We get more Lena Khans, AOCs, and Elizabeth Warrens. They don't give a fuck about the stock market. They want that shit to go down. So over 40 years, that's done great, but this is meaningless. This shit I'm doing right here, it's worthless. It's garbage. Who cares? Why? Why does it matter? Well, let's do this. Let's look at the Nikkei. Nikkei, please, as my friends say. Okay. The Nikkei is the Japanese stock market, and it's right now at 49,000. But now let's look at that in the same framework, and you might be a little more concerning, very concerning. This should probably do it like this. That's all you can say is Nikkei, please. The Nikkei is the Japanese stock market. Okay. So these are the returns. So Japanese stocks, so US stocks are anywhere from 6.1, 6 to 13%. Let's write that down. US stocks. That sounds pretty good. It's like, I'll take my chances, you know. Any old stock, I don't need to look at AstraZeneca. Who cares? Any old stock would do the trick, but hold on, what if we were like Japan? And remember, keep this in mind, Japan sort of was like the number 2 economy. So that's like, you know, it's not like, okay, maybe what happens if we're, you know, not number 1? You know, it'll be very interesting to see how this works. So literally 1% return was possible over 35 years. Japanese stocks returned 1%. 35 years. 1% to today. Can you imagine? That's worse than Stanfield Capital. So don't assume the market's going to help you. We have to be vigilant. But we've had as much as a 12% return over the last 5 years. So you get some pockets of strength that look good and some that don't. Now, what if we did, you know, a country like France? What do you think? How we do in France? Should we pick something else? Let's try France. They have a stock market, or index is called CAC there. I know a lot of you guys like CAC. How does that pronounce? CAC? Some of you really like it. All right, let's do the math for that. Who gives a cack? So here you had 1 to 6%. I'm going to make a tweet about this. It's going to be fun. Anyway, point is, these are some returns you can expect. So 11% sounds pretty good. Now you're making a few assumptions. One, the market will pay 20 times earnings in 2030. So could you make another assumption? Is there another way to look at this? I think there is. One of the ways you could look at it is say, what's the present value? Well, if you say my cost of capital is this risk-free rate, and we'll explain why in a second, but let's say it is. My cost of capital is this risk-free rate. It's 5 years from now, and I'm going to have $152 in 5 years. What's that worth today? Well, that's worth $124 today, and that's a 36% upside. So the market's missing something that potentially could be worth that much. But your risk-free rate and the risk-free rate the market's using are different. The market might say, well, this isn't as safe as a bond. It's a company, right? Is it as safe as a AAA bond? Well, in that case, the upside's less. Well, is it as safe as a BAA bond? Well, the upside's even less then. And is it as safe as a junk bond or a portfolio of junk bonds? Well, if you value it compared to junk bonds, which are almost equity-like, I mean, you don't get much security in a junk bond, it's still kind of cheap. But if you start to look at it as, well, what's my upside if that rate is more like a stock rate? You know, I assume we're going to make 8%, which again seems like a faulty assumption. Markets have gone up kind of 8 or 9% a year, but they're not guaranteeing to go up 8 or 9% a year. So this, to some extent, is guaranteeing you an 11% return. Again, what if multiples go down? Well, then you're really cooked, because if multiples go down, let's say even to 18%, 18 times. Well, now, even if they do this 66% increase in earnings, that means they're making 66% more 5 years from now than they're making today. That's a lot. You told me you're going to make, your business is going to grow by 60, 70% over 5 years, almost doubling the size of your already huge business. It's already one of the biggest businesses in the world. But the market says, instead of paying 20 times the earnings, I'll pay 18 times the earnings. Not much of a change. Multiples go, the standard deviation of multiples is very high. Now, it could also be higher, arguably, but you know, all that has to change is little, maybe not even one standard deviation change in multiple. And now you have only a negative 3% compounded return over 5 years. Now, the returns may start again, but what if AstraZeneca goes into a lull, right? What if the earnings actually start to drop? Thank you. And, you know, the CEO retires, and it turns out that, you know, the earnings don't go up 10 or 11% every year again. They only go up 1% a year. And the market says, well, I'll still pay 18 times, but with such a low earnings increase, you know, in 2035, just 10 years away, again, we're still going to hold it at 9% discount rate. You'd make far more money not buying the stock, even though all things considered, I mean, this is not a bad growth trajectory. 10%, 14%, 10%, 11, 9, 1, 1, 1, 1, 1. This is kind of the slow period where maybe they fire their CEO or whatever. But earnings are still growing. They're never declining, which is, you know, not a bad achievement. Even with that slow period, you're still growing. But if you could get a 9% return somewhere else with the same amount of risk, you actually would have lost money on a comparative basis. Now, of course, your share price is still going to go up. It's just going to go up somewhat anemically. What's my rate of return that way? Well, you just do equals rate, 10 years, minus this, positive that, and I see a 5% rate of return. Well, we look at our little handy sheet here, and we see that's equivalent to buying AAA bonds. Well, AAA bonds are going to give you that payment. Those are bonds of the highest tier corporate companies, or corporations like Apple and so forth, and AstraZeneca. You know, and you won't have any risk. You are the senior bondholder to those companies. If those companies do well, it doesn't matter. If those companies do poorly, it doesn't matter. They're going to pay you one way or another. And if they don't, well, you get to own the whole company. So you don't want that. But, you know, AAAs have never defaulted, really. So, you know, you can basically sleep at night and never even think about stock prices, whereas the stock price of AstraZeneca is going to gyrate quite a bit. These bonds are so secure, so much more safe. You know, why would you buy this when, you know, you're better off just buying AAA bonds? And I think that every time you think about the market, you should think about this kind of stuff. Now, this is macro stuff, but at the same time, you know, it's still important to think about what am I buying when I'm buying AstraZeneca? I'm buying a very good CEO, who's probably not going to live forever. I know that. As good as he is, he's not going to live forever. Somebody who takes over may suck. That new person that takes over, and this is why management is so important to so many investors. Management takes over, they're bad, and this is like not even bad. This is kind of more of a, well, it's sort of bad. It's more mediocre. Let me do more mediocre. 3% return. It's still like a really bad decision. You could make that same return buying bonds. So now, if markets are going to go down a lot, this isn't such a bad idea because you could have negative returns for some period of time. That has happened many times. So anyway, I just want you guys to sort of see the way I look sometimes at conceptualizing what is an equity. We haven't talked about that in a while. Like why would I buy this? What am I buying? And I'm buying, a share of a company for 19 times earnings that, is going to grow earnings pretty well. And in 4 or 5 years, probably could give me a good return, but what am I foregoing by investing in other things? So sort of a basic finance lesson, but a little bit more, applied to stocks in particular.